What's the best investment of the last 10 years? Gold, stocks, or crypto? Today, we find out with real numbers. Picture three college roommates, Mike, Sarah, and James. Same dorm room for 4 years, same ramen noodles, same broke college budget. But the moment they each landed their first real job and had $10,000 sitting in their bank account, they made three very different choices. Mike believed in something real, something you could touch, something that had held value for thousands of years. He put his $10,000 into gold and silver. Sarah had been reading, a lot. She kept coming back to the same thing, the stock market. Index funds, boring and slow and steady. She put her $10,000 into an S&P 500 ETF and basically forgot about it. James was the excited one, the one who stayed up until 2 in the morning watching charts. He had discovered crypto. Bitcoin was the future, he said. He put his $10,000 into Bitcoin and a handful of altcoins. Same starting point, same amount of money, three completely different paths. Let's follow each of them, year by year, and see where they ended up. First, let's understand why each of them made the choice they did. Because none of them were stupid. Each had a real argument. Mike's argument for gold and silver was simple and ancient. Gold has been valuable for over 5,000 years. Every civilization that ever existed recognized its worth. Paper money comes and goes. Governments collapse, currencies get replaced, inflation eats savings. But gold? Gold is still gold. A Roman soldier 2,000 years ago could buy a good toga and sandals with an ounce of gold. Today, that same ounce buys a nice suit. The purchasing power barely changed over 2,000 years. Silver had the added bonus of industrial demand. Used in electronics, solar panels, medical equipment. Real-world utility on top of its role as a store of value. Mike felt safe. He wasn't chasing gains. He was protecting what he had. Sarah's argument for index funds was about math and history. She had read that over any 20-year period in history, the S&P 500 had never lost money. Never. Through the Great Depression, World War II, the dot-com crash, the 2008 financial crisis, if you held for long enough, you always came out ahead. Always. She also read that most professional fund managers, people whose entire job is picking stocks, fail to beat a simple index fund over the long run. If the experts can't do it, why would she try? Buy everything, hold forever, let the American economy do the work.
It's
Simple, boring, and historically the most reliable path to building wealth that regular people have ever had. James's argument for crypto was about the future. Bitcoin was created in 2009 as a direct response to the financial crisis. Banks had failed. Governments had printed trillions. The entire financial system had nearly collapsed. And ordinary people paid the price, while banks got bailed out. Bitcoin offered something different. Fixed supply. No central authority. No government could print more of it. No bank could freeze it. And as more people discovered it, demand would increase while supply stayed the same. James saw the internet in the 90s. He saw what happened to people who laughed at Amazon in 2000. He wasn't going to laugh at Bitcoin. 3 smart people, 3 legitimate arguments. Now let's see what actually happened.
Gold is about
Year 1.
$1,800 an ounce.
Mike bought gold
and
at around
silver is
$1,800 per ounce, and silver at around $25 per ounce. He split his $10,000, $7,000 in gold, $3,000 in silver. By the end of the first year, gold had moved sideways. Silver had actually dipped slightly. His $10,000 was worth about $9,600, down 4%. Not catastrophic, just frustrating. Sarah's S&P 500 ETF had a decent first year. The market was up around 15%. Her $10,000 was now $11,500. She barely noticed. She had set up automatic contributions and wasn't watching the numbers obsessively. James had a wild ride. Bitcoin went from around 30,000 to nearly 60,000, then crashed back down to around 35,000. Some of his altcoins did even worse. By the end of year 1, his 10,000 was worth about 11,000. Up, but the roller coaster had been exhausting. After year 1, Sarah was slightly ahead, James close behind, Mike in the red. Year 2, this is where things got interesting. Mike saw gold start to climb. Inflation was rising. People were scared. Historically, gold performs well when people are scared and inflation is high. And 2022 was exactly that environment. His gold position recovered and then some. By end of year 2, his 10,000 had become approximately 11,200. Finally positive. Sarah had a brutal year too. The S&P 500 dropped nearly 20% in 2022. Her 11,500 became around 9,200. She was below her starting point. She had a moment of doubt. But she remembered what she had read. Every crash is temporary. She didn't sell. James had an absolute disaster. The crypto market collapsed in 2022. Bitcoin went from nearly 50,000 down to around 16,000. Several of his altcoins went to near zero. His 11,000 became approximately 3,500. He had lost 65% of his money. He felt sick. After year 2, Mike was leading. Sarah was below her starting point. James was devastated. Year 3. Gold continued its slow climb. Inflation remained a concern globally. Mike's position grew to around 12,500. He was feeling vindicated. Sarah's S&P 500 started recovering. Markets bounced back hard in 2023. Her 9,200 grew to approximately 12,000, almost back to even, and heading higher. James was torn. Bitcoin had started recovering from its lows. His 3,500 became around 5,000, still more than 50% below where he started, but the direction had changed. He held on. After year 3, Mike slightly ahead, Sarah close behind and catching up fast, James still deeply in the hole, but showing signs of life. Year 4 through year 7. This is where the long-term story really takes shape. Mike's gold continued its steady march upward. Gold is not exciting. It doesn't double overnight, but it moves, slowly, consistently, in the direction of up over long periods. By year 7, his original 10,000 had grown to approximately 16,000. 60% gain over 7 years. Not bad. Better than a savings account. Better than inflation. Respectable. Silver was more volatile and hadn't kept pace with gold. His blended position, gold and silver together, averaged out to that 16,000 number. Sarah's S&P 500 had compounded quietly in the background. Year 3 recovery. Year 4 continued growth. Year 5 good. Year 6 great. Year 7 exceptional. The market had some volatility. It always does. But the overall trend was relentlessly upward. By year 7, her 10,000 had grown to approximately 19,500, nearly doubling in 7 years, and she had barely thought about it. James had the most dramatic story. After the 2022 collapse, Bitcoin spent 2 years recovering. Then in 2023 and 24, it went on a historic run. New all-time highs, institutional adoption, spot Bitcoin ETFs approved by the SEC. The narrative James had believed in from the beginning started becoming mainstream. His altcoins were a mixed story. Some had died completely, some had done extraordinarily well. On balance, by year 7, his original 10,000 that had fallen to 3,500 had climbed back up to approximately 22,000, more than doubling from his starting point. But the journey had been brutal. The stress had been real. There had been months where he genuinely thought he had lost everything. After year 7, James narrowly ahead, Sarah close behind, Mike in third but solidly positive. Year 8, 9, and 10, the final stretch. Mike's gold position continued its steady upward climb. Gold broke through $2,000 per ounce, then $2,500, eventually pushing toward $3,000. His original 10,000, after 10 full years, had grown to approximately 20,000, a clean double, 100% return over 10 years. 10% per year on average, which sounds great until you compare it to what the others achieved. Silver underperformed gold over the decade, more volatile, more industrial exposure, more affected by economic slowdowns. The blended position settled at that 20,000 number. Mike was not unhappy. He had protected himself from inflation, he had doubled his money, he had slept well every night. No panic, no crashes that felt existential. Gold did exactly what he expected it to do. Sarah's S&P 500 ETF, after 10 full years of compounding, had turned her original 10,000 into approximately 26,500, a 165% return. Every dollar she invested was now worth $2.65, and she had done almost nothing. Set it up, ignored the crashes, kept going, let the machine run. The math of compound interest had quietly worked in her favor year after year. She hadn't tried to time anything. She hadn't stayed up watching charts. She had lived her life and let the market do what the market does over long periods: go up. James's crypto portfolio after 10 years was the most complicated story. Bitcoin itself had performed extraordinarily well over the decade, from around 30,000 to ultimately much higher, reflecting the maturation of the asset class and institutional adoption. His Bitcoin position alone had performed better than almost any traditional asset, but his altcoins were a different story. Some had gone to zero, some had done 100 times. On balance, his diversified crypto portfolio, after accounting for all the wins and losses, had turned his original 10,000 into approximately 31,000, a 210% return, the highest return of the three, but also the highest stress, the highest volatility, the deepest drawdown. That period in year 2 when he was down 65% felt genuinely terrible. He had considered selling multiple times. The only reason he hadn't was stubbornness, and that stubbornness had paid off. So what did we actually learn from Mike, Sarah, and James? The first lesson is that time horizon matters more than asset choice. All three of them made money over 10 years. All three beat inflation. The differences in outcome, while real, were less dramatic than most people expect. The asset class matters less than most people think. Holding for the long term matters more than almost anything else. The second lesson is that volatility is the price of higher returns. Sarah's smooth, boring ride in the S&P 500 came with its own crashes. She was down 20% in year 2. Mike's gold was stable but slow. James's crypto had the highest return, but also the scariest journey. You don't get higher returns without higher risk and higher volatility. These things are connected, always. The third lesson is that the best investment is the one you can stick with. This is the one nobody talks about enough. It doesn't matter if Bitcoin theoretically has higher returns if you panic sell every time it drops 50%. It doesn't matter if the S&P 500 historically outperforms gold if you bail during every correction. The best investment strategy is the one you can actually follow through on, emotionally, psychologically, practically. Mike could sleep at night. His strategy matched his personality. For him, gold was right. Not because gold is objectively the best asset, but because he could hold it without losing his mind. Sarah had the discipline to ignore the noise. She had done enough reading to trust the long-term data. She could see a 20% drop and say, this is temporary, and actually believe it. For her, index funds were right. James had the stomach for extreme volatility. He could watch his portfolio drop 65% and hold on. Most people cannot do this. Most people who bought crypto in that era sold during the crash and locked in their losses. James happened to have the personality to hold. For him, crypto worked, but only because of who he is as a person. The fourth lesson is about diversification. Here's what none of them did, and what many financial advisors would suggest. What if you had split that 10,000 into thirds? 3,300 in gold and silver, 3,300 in an S&P 500 ETF, 3,300 in crypto. Your worst year, 2022, would have been painful but not devastating. The gold position would have cushioned the crypto crash. The S&P 500 would have cushioned both. And your 10-year return would have averaged out to somewhere around 25,000. Not as high as James's pure crypto bet, not as stable as Mike's gold, but with dramatically less stress and significantly less risk. Diversification doesn't maximize your gains. It minimizes your regret. Let's talk about what each asset class is actually good for. Gold and silver are stores of value, thousands of years of proof. They don't grow dramatically, but they don't collapse dramatically either. They protect against inflation, currency devaluation, and geopolitical instability. If you're worried about the dollar losing value or a financial crisis, gold belongs in your portfolio. Most serious financial advisors suggest 5 to 10% of your portfolio in precious metals as a hedge. Not your entire portfolio, a hedge. Index funds are wealth-building machines for patient people. The data is overwhelming. The fees are almost nothing. The diversification is instant. The track record spans a century. If you're investing for retirement that's 10, 20, 30 years away, an S&P 500 or total market index fund should probably be the core of your portfolio. This is what Warren Buffett recommends for his own family. It's boring, it works. Crypto is a high-risk, high-reward emerging asset class. Bitcoin has the strongest case: fixed supply, growing adoption, digital gold narrative. Ethereum has utility as a platform, but the broader crypto market is still largely speculative. Prices are driven by narrative and momentum as much as fundamentals. If you invest in crypto, only invest what you can afford to lose completely. Not because it will definitely go to zero, but because the volatility requires that mentality to hold through the bad periods. Most serious advisors suggest keeping crypto to 5 to 10% of a portfolio at most. Some say zero. So what should you actually do? Here's what I'd tell Mike, Sarah, and James if they came to me at the beginning, not knowing how things would turn out. Build your foundation first. Emergency fund. 3 to 6 months of expenses in a high-yield savings account. This isn't investing. This is protection. Without it, any investment becomes a gamble because you might need to sell at the worst possible moment. Max out tax-advantaged accounts. Roth IRA first, $7,000 per year. Inside that Roth IRA, buy an S&P 500 or total market index fund. Let it compound tax-free for decades. Add precious metals as a hedge. 5 to 10% of your investment portfolio in gold. Not silver initially, gold is more stable, as insurance against inflation and currency risk. Not for growth, for protection. Consider crypto only after the above. If you understand it, believe in the long-term thesis, and can genuinely handle the volatility, a small allocation of 5% or less is reasonable. Go in knowing it might go to zero. Go in knowing it might go up 10 times. Either is possible. The boring middle path, foundation, index funds, a little gold, a little crypto, has historically produced excellent results for patient investors who stayed the course. Let's bring it back to Mike, Sarah, and James. 10 years later, the three friends met for dinner. Mike with his $20,000, Sarah with her $26,500, James with his $31,000. James technically won the numbers game, but he also had 2 years of genuine financial anxiety. 2 years of wondering if he had made a catastrophic mistake. 2 years of stress that affected his sleep, his relationships, his work. Sarah won the quality of life game. She had spent those 10 years not thinking about her investments at all. She had lived her life. She checked her account occasionally, added money when she could, and watched it grow quietly in the background. Mike slept the best. He knew exactly what he owned, why he owned it, and had never once panicked. His return was the lowest, but he was the most at peace with his decisions. None of them were wrong. None of them were stupid. They just had different personalities, different risk tolerances, and different definitions of winning. The right investment strategy is the one that matches who you actually are, not who you think you should be. If this video helped you think differently about investing, hit the like button. It really does help more people find this content. And subscribe, because next week, we're talking about the Roth IRA, the account that lets your money grow completely tax-free, why it might be the single best financial tool available to regular Americans, and exactly how to open one. I'm Richard Pemberton. Everyone calls me Rich, and I'll see you in